Hello to everyone, my name is Gregor Horvat and welcome back to our regular, on a weekly basis, video analysis surfing the Elliott waves, sponsored by Orbex. So I was on a vacation for the last 2 weeks, so I'm very excited to be back. In fact, there was a quite tight range trading over the last 2 weeks. So it looks like it was a perfect time for a vacation, but I'm sure that volatility is going to come back very soon. We have Fed today and very important non-farm payrolls report on Friday. As you know, investors, market participants are afraid of this recession because of the hikes while we have this economic activity coming down. So if the numbers will be very bad on Friday, well, I think that investors may look towards limited hikes from the Fed, and obviously this could potentially mean a new change in cycles. But on the other hand, if they will ignore the recession risks and continue to hike, well, then I think that stocks could see much more weakness while the US dollar could rally. But before we go to to the S&P 500 charts, I really want to look at this correlation between US dollar and the 10-year US yield. So at the top, I have this in orange. You have the 10-year US yields, which, as you can see, has a positive correlation for the last few months with the US yield. So if the US yields goes higher, obviously US dollar appears to be very strong. And this cycle came in place since November of last year, when actually Fed announced this hiking policy. But now what we see is that US yields are coming to the downside, but US dollar still making a new high. So you are seeing a divergence here. The question is, which one will catch the other? Okay, will US dollar see limited upside if the US yields will continue to move to the downside, or will the US yields maybe again turn back towards the highs and dollar will move even further? So I think that very important is to look at the 10-year US notes on the opposite side, obviously, of the US yields. And as you can see back here in March, from January, February, and March, we had the same negative divergence here. Okay, so it was the US yields turning to the downside. You had the US dollar index moving higher, but then the 10-year US notes has stopped at the resistance and made a sell-off. So it means that US yields turned higher and catch up the bit with the US dollar. And now we are in a very similar pattern here. So I'm wondering if this resistance that I see it like a do or die level will hold on the 10-year US notes, or we will break through. If we will break through, well, meaning if this resistance will not hold, then US dollar bulls, in my opinion, will likely slow down. So I think it's very important to keep an eye on these developments right here. Also, it's very important to keep an eye on commodities as well. We have seen a very sharp reversal on commodities in many sectors, meaning that even US dollar could is maybe having some benefits from commodities selling off. So here I have this commodity higher degree chart. You can see that I am looking at an ABC correction. We've been tracking this one for a while over the last few years, and then what happened? Well, very nice and strong recovery occurred, but nothing moves in straight line. Okay, so that's a very strong move. Yes, it's definitely like start of a new higher degree uptrend, but even uptrends have a pullbacks, have a setback. So I'm looking and expecting this ABC correction. Normally, whenever I'm tracking the higher degree correction, I will look for a retracement to 38.2%. Okay, that's the minimum objective that we could potentially retest. But ideal zone would be the 61.8%, which also comes in around this previous wave for swing high. So that would be quite interesting zone. So it means that we have a lot of room here for potential more weakness. So at the same time, we have to consider that yes, there can be more, that there can be a recession coming. It means that US dollar could, in this case, could probably see much more upside, because you know US dollar will act as a safe haven whenever we are seeing a recession, meaning stocks and everything will come to the downside. Okay, so we will see how this will play out. This is just an objection. It's not something. It's not a view that I'm sticking with it. I still think that there is some chance that euro dollar will potentially stabilize around parity. So if we look at the euro dollar, I'm not really sure what will trigger a potential reversal here, but looking at the higher degree charts, well, we are approaching this 78.6%. I still think that this can be the final leg of a very complex decline that we are experiencing down from 2008 highs. Okay, so we will see what happens now there. I think that ECB is definitely aware that weak euro is making inflation even worse. So I think that if we see a parity or even move below that, that sooner or later maybe they could even intervene here in this market and potentially we could see price stabilization. So looking at the smaller degree charts here on the euro dollar, firstly the daily, well, you are potentially in a wave 5. Well, there's an idea that maybe even wave 4, okay, could be as a flat correction, meaning that you can see like this one move to a new low and then a reversal higher for a wave C. But in such case, I would really love to see that market will stop at these fib levels. Okay, you have 138.2% and 161.8% extension of this wave 4. So this should be then limited weakness here if we really are going to track potential flat. So to give you the better idea, that would be the pattern then for a potential flat formation. Okay, you would see an ABC formation here for this wave 4 and then a new sell-off. So very strong resistance definitely remains on a higher degree charts here at 108 level. Okay, but for now, well, since market is trading to the downside, we still have to consider, as I said earlier, that we could see parity. Okay, so I definitely want to label my primary charts in the direction of a trend, because obviously it's much easier to follow. So what I'm looking at, well, I'm tracking wave 5. Wave 5 should be made by 5 subwaves. So if you look here on the 4-hour chart, well, I can count waves 1, wave 2, wave 3, wave 4. Looks like that you are in a wave 5. And even this wave 5 of a smaller degree should be made by 5 subwaves, because Elliott wave is fractal. Okay, so you see similar patterns in different degrees of chart. So looking here at the hourly chart, well, notice that you are here, you made this wave 1, flat correction for a wave 2, nice extended 5-wave down now, 5 subwaves clearly visible within wave 3. So maybe some supports could be happening in the near term. By the end of the week, watch out for this wave 4 rally and then potentially further sell-off. Whenever this wave 4 rally occurs, apply your 38.2% fib retracement against this wave 3, and also keep an eye on this resistance here, minor one at the wave 4 here around 102.73. Okay, so that's the level for to watch for a potential new sell-off whenever we see, if we see a rally. If maybe suddenly we see a break above 104 level, then I think that we could be dealing with a bottom, even if just temporary. Now let's take a look on Kiwi here. Well, we have seen some very nice move to the downside on Kiwi, and currently what we are seeing is moving into some nice potential first support. But since I'm aware of everything what is going on, there was even an Australian bank who made a new hike, 50 basis points this week. So more hikes is probably closer to recession. So especially if economic activity is not doing so well like lately. So that's the first support. The second support on Kiwi here is around 78.6%, so still plenty of room for potential further sell-off. So I'm just patiently waiting, also watching stocks, of course, especially after non-farm payrolls report on Friday. This should be very important to see if we can see some price stabilization and potential dollar turning around, or will this risk of keep keep going on, keep continue? So if suddenly stocks would, let's say, rally and US dollar will turn around, then I think that Kiwi could be quite interesting. If we see any bounce from one of those supports in 5 waves, then I think on the short-term basis could be quite attractive, at least for me. Now, on the smaller degree time frame charts, well, I'm looking here at here I have, okay. So here we have this bearish impulse going on, and there can be room for more weakness based on this second count that I have also back in my mind, or even this could be now potential ending diagonal in the making here for wave 5. So we'll see if market could potentially stabilize at a new low. This could be quite interesting, as I said, especially if maybe suddenly we will see some bounce on stocks. But for now, US dollar is very strong. We are seeing still stocks in very bearish mode, so you have to be aware that there can be more weakness coming on those currencies such as Aussie, New Zealand dollar, euro, and others. Okay, there are no reversals happening yet. So for any reversal before calling a bottom, for me, it's important to see 5-wave rally from the low. Okay, that was some nice, interesting recovery here back in the mid of June, but that was not a 5-wave movement. It was only a 3-wave rise. So for now, whenever we see only 3-wave rise, we have to stick with a higher degree downtrend. Okay, now let's take a look also on the euro pound. Well, euro pound on a multi-year chart, we can see that there was a very nice, interesting bounce happening away from this 0.830 area, 20 around there. So we have seen some nice recovery. More importantly, we are seeing this recovery coming down of this, coming up from this downward channel, and this has occurred with 5 waves as a leading diagonal either for wave 1 or wave A. So now what we are seeing is price is making some pullback, and this pullback should be made by 3 waves, meaning it's a corrective flag. So what I'm looking at, well, this is the 3-wave substructure that I'm tracking. That's the first leg, wave A, then you have a wave B, and now expecting a wave C drop. Now wave C could be very similar compared to wave A. So you have wave C here, first support at 84.60, and the second one would be at 83.90, where you have also this former wave 4. And now let's take a look where we have some fips for potential limited weakness here. So the fips, the 61 and the 51% are probably going to be very important, much more than the 38.2, because wave A is below that fib level. So I'm looking for this to be quite an interesting potential zone for a bounce, and I will definitely have this pair on my closer watch list. Okay, and now finally let's take a look on the S&P 500. Now on a higher degree chart, still what we are seeing, well, it's a very nice deep pullback. A reversal has started since start of the year when we had this new change in policy from the Fed. Obviously US dollar is getting strong while the US stocks are coming to the downside, but still I know that there is a lot of fear going on. So sentiment is becoming very pessimistic, and that's what we need to have in mind, because we know that markets move from pessimism to optimism and vice versa. And whenever we see such a strong and deep pullback, we just have to be aware that at some point there will be a support and an interesting reversal. I can remember very well how bearish sentiment there was back in March of 2020. It was even here back in 2018, even 2008, 2009. So it's all very similar. We have a very deep pullbacks, a lot of fear going on, but then suddenly markets will reverse, because always when there is a recession coming in, when there is a very strong sell-off, maybe still we'll see another one here on stocks. Well, after that, Fed will probably stop with hiking rates, and then after the first shock to the downside on stocks, you will see again stocks trying to picking up because Fed will have to do something to support the economy back to normal activity. Okay, so we'll see what will happen. I see very nice pullback here based on a technical picture, very similar, almost similar, I should say, compared to this one back in 2020. So we'll see if this market could maybe potentially turn around. Of course, from a confirmation point of view, you should see this upper channel line broken to make sure that we are back in bullish trend. Looking here on a smaller degree time frame charts, firstly, this one, the primary, it could be counted to move from the highs in ABC, X, and another ABC and potential bottom here. But again, this smaller channel should be broken here around 4,000, I should say. So if we see a daily close, even better, maybe weekly close on Friday above 4,000, then I think we are going much higher, even if just temporary. Another alternate view, you can count this also as a WXY with an ending diagonal here in the final part of this complex correction. So here I allow prices to come again back to a new low and then to the upside. And you know how bearish sentiment would likely be if we break this previous swing low right here at June low. So I'm sure that this wedge pattern is something that we should pay attention on, especially if you maybe see then limited weakness here around 3,500. Okay, so definitely I will have this pattern in mind as well. Okay, traders, thank you very much for your attention. I hope that you enjoyed this video, and again, talk to you soon. Bye.